Said you were a man of your word.
I am. I'm only burning my half. All you care about is money. This town deserves a better class of criminal. And I'm gonna give it to them. Tell your men they work for me now. This is my city.
They won't work for a freak.
Why don't we cut you up into little pieces and feed you to your pooches? And then we'll see how loyal a hungry dog really is. It's not about money. It's about sending a message. Everything burns.
The most recognized measurements of expected equity volatility is the Vix Index. The SIBO Volatility Index, as it's officially called, is widely reported by financial media as the benchmark of volatility. You'll also hear financial news outlets refer to it as the fear gauge, but for our purposes, we'll refer to it as the Vix Index. So, what is the Vix Index? Well, as its name implies, it's an index. As a measurement tool, it is not a tradable product. The Vix Index indicates the degree or expected level of uncertainty in the marketplace. Specifically, the Vix Index measures 30-day expected volatility of the S&P 500 index by using SIBO-listed options on the S&P 500 index as inputs. You may know these as SPX options. In math lingo, the Vix Index is expressed in percentage terms as an annualized one standard deviation move of returns on the S&P 500 index. Let's unpack that. The Vix Index calculation uses SPX option prices. The prices investors are willing to pay for options typically reflect how much the underlying asset, in this case the S&P 500, is expected to move over a given time frame. The key word here is expected, which means the Vix Index is a forward-looking indicator of market volatility. Between 1990 and 2020, the closing range on the Vix Index has been between 9.14 and 82.69. Higher Vix Index values suggest more expected uncertainty being priced into the marketplace, while lower values indicate less expected uncertainty. Typically, the Vix Index has an inverse relationship to the S&P 500 index. What does that mean? In most cases, when the S&P 500 index goes up, the Vix Index goes down, and vice versa, but not always. Let's take a look at how the Vix Index is used. It is most widely used as a gauge or indicator about the future levels of the market. It's important to remember the Vix Index itself is not directly tradable. For more sophisticated investors seeking expected volatility exposure, SIBO lists tradable Vix futures and options. Let's summarize what we've learned. The Vix Index is calculated using S&P 500 index option prices. The Vix Index is a forward-looking indicator of expected stock market uncertainty. A higher Vix Index level suggests greater collective uncertainty in the market, and a lower Vix Index level suggests more certainty. The Vix Index itself is not tradable. SIBO lists Vix options and futures for investors seeking expected volatility exposure.
Everything you just heard in the previous video, I'm not saying disregard it, but take out all the fancy jargon and just focus on what exactly it is. VIX, V-I-X, it's a volatility index. So think of it this way. It's a fear gauge. It's telling you 30 days out how the future looks. So imagine being able to invest and have a parameter of how the future outlook is, and it's based on options and futures contracts. And if that doesn't make sense to you and you're a long-term investor, don't worry about it. Just basically all you need to know is that this is a fear indicator. So I'm going to show you where you could have used a VIX. Look at 1999. That's when the stock market crashed. That was around the time we had the tech disaster. So it was a tech crash. And if you look, in 99, it was high as 40 at one point. A little bit above it, actually. And if you look around 2017 to the right of it, the highest the VIX got was over 50. Looks like it's a little bit over 55. And do you know what happened March 2020? Yes, it was the pandemic, COVID-19. So this fear gauge, you can use it to your usage, however way you want to use. But anything over 20 is a cause for concern. Not as much, if it's around the 20 range, anything 17 or under, that just means that more people are buying and it's not as much uncertainty. But when you see it up with 50, the market's uncertain. That just means that it's more volatile, it's more fear, people are scared. So if the Great Depression happened, I expect to see that 50 at a high level. So when you see it less than 15 or 17 range, 20, that's normal. That means that there's no fear, there's no uncertainty. But when you see it higher than that, and you see those peaks and valleys, if you look at all those events, something bad happened around that time. If you look around 2008, the housing market crash. 99, tech crash. 2020, pandemic, COVID crash. So that's how you use a VIX. VIX. You can't trade the VIX. You would have to go with VXX or UVXY, and there's some other ones I'll talk about later on. Or you can go to my Bear series. In the Bear series, I explain VIX pretty well. Those are some prior videos. You'll have to go back. I can post them below in the comment section if need be. Let's take a look here, March 1st, 2020. If you look March 1st, 2020, it shot up. It opened at 34 and it closed at 41.94. That's showing you that there was a lot of volatility at the time. And that's because of the COVID pandemic. We were in an unknown era or unknown situation with a pandemic. Most of us had never experienced what it was like to go through a pandemic. Now that we have some experience with it, we know now what to do. But back then, when COVID first happened, nobody knew what was going on. And if you look here at this 5-year chart, it's once again showing 2020 and what was going on. It was higher than 60 at this point in time. So this is a good chart. You should always zoom out and look at things from the highest amount of time you can. You can do all time if you want to. You see the blue bar where it says 5-year. So that's going as far out possible as I would go. So you look at the 5-year and you can see how the VIX is done over time. And you see the COVID pandemic being one of the highest. Now we're on to the 1-year chart. And so this is a 1-year chart of the VIX, VIX. And if you look at 2022, currently we're right here at 28.85 at the time. And you can go back and look at some prior years also too and see how high it got. So 28, it's not very volatile, but it's enough to be concerned, enough to know what's going on. And right now we have supply chain issues. We also have high inflation. We have interest rate hikes. So it's a lot of fear going on. Let's look at the 3-month. The 3-month, December, it shot up over 30 points at the time. And the reason being, once again, supply chain issues. Also, too, we had a new variant, COVID variant. Most people call it Omicron. Some people call it Omarion. Yeah, just like Delta. This pandemic, this virus is not going anywhere. It's just going to mutate and transfer over into something else. And so that caused the VIX to spike up over 30. So once again, you see how you can use it? You can use it to your whatever use you want to use it to. You can use it to buy stocks. You can know when you're going to see sales, or you can use it to trade options. So it depends on what you are. If you're a long-term investor, you can use it to your use when you want to buy stocks. Or if you're an options trader, you can use it when you want to buy puts or hedge against the market. So it all depends on what you want to do with it. The VIX works inversely against SPX. So SPX is just the S&P 500. For those of you unfamiliar, you might want to go back and look at some of my videos. That just means the top 500 companies of America. And I'm going to show you something right here. You see this chart right here where that hand is? That's showing you how they work inversely. So when one goes up, the other one goes down. So that's how you can use VIX to gauge the market. When the VIX is high, you're going to see the stock market go down. When the stock market is up, you're going to see the VIX go down. It's that simple. Keep it very simple. It does not need to be overly complicated. I know I just showed you a video previously showing how complicated it can be, but just remember, it works inversely towards one another. Right here on this chart, you see a circle, January 3rd. The VIX has slowly been gaining traction, meaning that it's fear. It's a lot of volatility going on in the market. It slowly went up. It's trending up. And as you see it going up, you see SPX going down. Right here, you see where SPX is going down. That's showing you that they work inversely in correlation to each other, meaning when one goes up, the other goes down. It's not rocket science. Let's keep it simple. Voila. Dow Jones falls more than 800 points in 7th straight down day. S&P 500 pulls back. And if you look here below where you see the red, Dow Jones on the left, negative 1,033 points. S&P 500, 164. NASDAQ, 634. That's showing the markets in red. Even Bitcoin was wiped out by 130 billion. And a lot of people say Bitcoin works inversely to stocks, meaning when stocks are up, Bitcoin's down. When Bitcoin's up, stocks are down. So that's working inversely. I don't think cryptocurrency is quite yet caught on to that yet, that it's supposed to be up when stocks are down. So yeah, we're kind of in a phase right now where you won't see that. I do believe Bitcoin is like a teenager. It needs time to grow. It's volatile right now, and soon it will be a hedge. Let's take a closer look. Dow falls 1,000 points in 7th straight day as stocks head for worst month since March 2020. Remember what happened in March 2020? The pandemic. COVID-19 was introduced to the world, or at least to America, but we're not going to get into that yet. So this is breaking news. And the reason this is big is because March 2020, that was very significant. That meant it was fear in the market. So once again, that's how you use the VIX. You can base it on fear. Another chart showing how high the fear was at the time when March 2020 came. If you look here at this chart, it's currently going down significantly, and that's because people accepted the pandemic and we learned to live with it, so it wasn't as much fear as it was in the past. Take a look here at the year to date. Remember, it's only January 24th in the year 2022, so it's not a lot of data to shoot off of. But if you look over there in the left corner at the very bottom, you see it was below 20. Once fear started gauging up and inflation and interest rate hikes were being talked about early in the month, it shot up to 27, all the way up to the right at the very top. So yeah, it's a fear gauge. This is a VIX plus 224.93%, up 24 points. If you look here, it's not always going to be up or down for long periods. It's short-term volatility. Remember, I said 30 days out, so it always comes back like a rubber band. January 24th, Monday. Let's take a look here. You see the market dipping. That's a downtrend when it's going down. So it ended up at around 422. This is a SPY we're looking at. S&P 500, top 500 companies. And then it recovered during the end of the day. So that's a market reversal. That's what happens when you see it go down and you see the market reverse. So that just means that there was a downtrend. Something happened. I believe it was buyers and sellers fighting for position. And a lot of people bought the dip. So it recovered. Once again, let's look at it. 432, the SPY. We're looking at the one-day chart. You can see all the peaks and valleys of the day. So this day was very volatile. You don't see it too often with market reversals like that. And I haven't went into candlesticks, but I like to use line graphs because I feel it's much easier for most people to see what's going on. When you use candles, it gets a little confusing. I have a vast amount of experience with candlesticks. That's something we'll have to get into later, but for now, this works. Let's look at this market reversal. That's 99 points. From 1 p.m. to 4 p.m., you see a market reversal. You see down there below where it says 124.22, at 1 p.m., you see a market reversal, and it ended the day plus 99.13 to end in the green. That's not where it ended up at. That just shows that the market reversal from 1 p.m. to 4 p.m. was 99 points. So that's pretty significant. That's a market reversal. That just means it downtrended and then it uptrended from there. So you see peaks and valleys. That's a volatile day. So you've seen it was negative 164 on the S&P 500. By the end of the day, it was in the green at 12 points. That's a pretty significant downtrend leading up to an uptrend. So 99 points for the Dow Jones and the NASDAQ, 86 points. So that goes to show you how market reversals can work. That's a pretty violent market reversal. This is a fear and greed index. You see it's at 41. That means that fear is at a 41 level. And you look at the chart on the right, you see where fear says 43. So that's how you look at this, and that's how you use it. I'll list the website where I got this from along with the others. This is a lazy man or woman's way of checking the fear and greed indicator. If you don't want to use a Vix, this is another way too that most people don't talk about. You could also too find out where the smart money is lying, such as bonds, such as the safe haven demand, where bonds have outperformed stocks by 4% during the last 20 trading days. That's just showing you that bonds is a safe haven right now instead of stocks. So it's volatility in the market, and bonds are much safer for some people or the smart money. Once again, this is a lazy man or woman's way of seeing the charts. If you don't want to look at the charts or the VIX, you can also come here and check out this website. I'll list it below, but this is showing the VIX and the 50-day moving average, showing that it's 43.39% above its 50-day moving average, and the stock price strength of the 52-week lows exceeding the number of highs. So this is a lazy man or woman's way of checking it if you are not good with charts. And at the end of the day, what does this mean to you? If you're a long-term investor, you could have bought on a dip and bought some discounted stock like Apple. Or if you're a day trader, you could have bought SPY puts and made some money, such as this person above. And there you have it. That's why you need to learn how to use a VIX as a fear gauge. You could buy discounted stocks, and also too, if you're a day trader, learn how to use it so you can make money. So hopefully you learned something and this was a valuable tool for you. Thank you for tuning in to the Monk Investor.